Good afternoon. I hope you're doing well. My name is Silei Veia. I am the operations manager here at Weekend Financial and Insurance Services. I would like to welcome you to our weekly wrap-up. And here with us is Graham Weekend, President and CEO of Weekend Financial and Insurance Services. Hello, Graham. Tell us what happened last week.
Yeah, thank you, Soleil, and thanks for our listeners being on the call. Yeah, a bit of a lower week for the U.S. equities. We saw the Federal Reserve may keep interest rates steady for longer than maybe many investors or the market anticipated. And I think that spooked the market to pause a bit. We saw the S&P and the Nasdaq fall about 1%, while we saw the Russell 2000 small cap index off about 3%. So about 9 of the 11 S&P sectors lost ground, led by real estate, healthcare, consumer staples. They all slid about 3%. On the other side of that, we saw crude oil really jump up about 4%. And keep in mind, crude oil is up about 21% so far this year. We also saw gold futures keep their ascent higher, right? They were up about 4%. We saw gold at new record highs at $2,342 per ounce. So both commodities rose. Why? We think there are some geopolitical concerns out there and the prospects that we might see reaccelerating inflation, the Fed not being as ambitious about lowering rates. If we look at U.S. Treasury yields, they firmed up and went higher. We saw the jobs report revealed yet another larger than expected gain of 303,000 new jobs. The average hourly earnings, they rose about 0.3% month over month. Now, from an annual standpoint, we still saw it fall to about 4.1 from 4.3. So that's good. We want things to slow, just not fall off a cliff, right? So we saw generally overall the labor markets are pretty healthy. The Fed's likely to keep a close eye on those wage gain numbers. That's something that's really front of mind for them. We did see Fed Chairman Powell, as well as FOMC member Kashkari, suggest that the U.S. economy's strength may keep rates cuts on hold, delayed. We'll just have to see how these cards unfold. But the Fed funds futures indicated that rate cuts are now expected probably late 2024 than previously assumed, maybe earlier. In some other economic news, we saw the U.S. manufacturing sector move into expansionary territory. Now, that was the first time since October of 22. We saw a pretty steep rise in consumer good prices, but at the same time, we saw the service sector cool for the second month, but rising fuel costs may reverse that trend. So we'll have to see how that all shakes out at the end of the day. But manufacturing orders did rebound 1.4% in February. Now, if we go overseas, we saw the Eurozone inflation fall more than expected in March. It slowed to about 2.4% from a year-over-year 2.6. So central bank looking back at their minutes, maybe signaling a June timeframe for their first rate cut. If we go over to China, we saw some private sector surveys reflecting some expansion in both the manufacturing and service area. Why is that important? Well, they're a huge manufacturer, a huge consumer of goods and services. And listen, sentiment's improving. That might not be a bad thing for the second largest economy in the world. Now, let's go to this week. We're looking at U.S. CPI report. Will be coming out on Wednesday. We got the inflation rate. Remember, the Fed's number is 2%. Now, we're not going to probably hit that, right? Do not expect that at all. But we want to see a trend consistently coming down. We did see consumer prices rise to about 3.5% year over year in March. Now, that was up from 3.2%. So kind of going in the wrong direction, spooking the market a little bit. So we want to kind of see it maybe pausing a little bit, starting to come down, starting that trend to make everyone happy, just not falling off a cliff, right? We want strong U.S. economy, but not too strong. Kind of that Goldilocks situation. You might hear that little phrase thrown out there left and right. So if we look at auction this week, we got the 30-year Treasury yields. They reached 2024 highs last week. We do have that auction on Wednesday, Thursday. So we want to see the appetite of the market buying those government notes. So we'll be looking at earnings. I know it feels like we just got done with them. Well, they're starting back up. The largest U.S. banks are coming out on Friday. We got J.P. Morgan, Wells Fargo, Citigroup, just to kick it off. Some other U.S. data that we'll be seeing this week will be some March PPI numbers, some preliminary consumer sentiment for April. And if we go overseas, what's going on with them? Primarily, it's central bank. We'll be looking at a decision out of Canada and Europe, kind of setting the tone over there. So
Thank you, Ram. It seems like the markets are pausing the recent rally. Do you think they will have a correction?
Well, keep in mind that correction is 10%, a bear market's 20, right? And we could always have to expect some sort of pause, right? Or a pullback or even a correction. I think that's a sign of a healthy market. You don't want it to keep going straight up, things getting overheated, those bubbles start to creating, which I don't think is where we're at right now because we got a really good economy, we got good earnings, we still have a strong consumer, low unemployment. We got a lot of just really good things going on in the economy. So I think whatever the market might pull back or pause, I think we'll get bought up. There's a tremendous amount of money, trillions of dollars sitting on the sidelines in these money market accounts, maybe wishing they had the opportunity to come in. Maybe they'll get that, and that's where some of that money will flow, especially if the Fed starts lowering interest rates and we don't signal a recession, which we're not expecting. I think that would be even more positive for the market and would get bought up as well.
Thank you, Ram. And thank you everyone for joining our call today. And we hope to see you in our next weekly wrap-up. Bye.
Take care.